So when we look at locations now to invest for our investor clients, we have two selection criteria. The first selection criteria is how do we determine which locations and cities to be investing in. The first parameter that we look at is the infra spendings by state as well as federal government. The second parameter that we look at is the economic diversity of the area. We don't want to be investing in markets or locations which are heavily dependent on any cyclic industries. The third parameter that we look at is the internal migration. We want to be knowing that whether that city is or location is gaining population or losing population. In real estate, price is nothing but always a factor of demand and supply. So all the data points or parameters that we look at are either related to demand side or supply side, and that's how they cause an impact on the price. So now once we have selected the location in the city, we get to the second criteria, which is now getting the best possible suburbs out of those locations where we should be investing in. We try to be sticking to 2 or 3 suburbs maximum. The reason is because we firmly believe that the narrower our search criteria is, the better the search results are. The parameters that we look at while selecting suburbs is entirely based on data. The first parameter that we look at is the trend of average days on market. Understanding the trend of average days on market is very critical for any investor to understand. The reason is because an increasing trend of average days on market means the demand is declining, which means the likelihood of rising prices is very minimal. The declining trend of average days on market is a favorable indicator for capital growth. The lesser the investor percentage is, the lesser competition the investor would have when their property goes out in the market for tenancy. So the second parameter that we look at is the investor percentage versus the owner occupancy percentage. And why that is important is because when as an investor you get into a market where the investor percentage is low, you have got less competition and you would be able to rent your property at a much higher rental. The third parameter that we look at is the median price growth in 36 months versus 12 months versus 3 months. And the reason why we look at these 3 parameters is because you can then extrapolate and see where that market is heading. It is a very clear indication of you to understand what you can expect in the short term. The fourth parameter that we look at is I think very critical. You want to look at the rental growth indicator. So if in a suburb there is a rental growth, it is a very good leading indicator for capital growth for multiple reasons. The first reason is if the rents are rising, it pushes the renters to become homeowners. That increases the demand. The other reason is if the rents are rising, it becomes a very good equation for the investors to be jumping into that market, which increases the demand secondfold. So that is really a good leading indicator, and in the past we have seen many markets where there was a very big disparity between rentals and their prices. The prices eventually caught up. In addition, we look at a lot of the data indicators, and also we do a lot of due diligence around bushfire checks, insurance checks, easement checks and flood checks. We empower our investor clients with information and credible data for them to make a well-informed decision. If you are not sure where to invest and how, then feel free to book an obligation-free chat and we are more than happy to help. This is Rohit from Investoraid. Looking forward to meeting you.